So now that we've gone through some of those summaries, and then in the third segment, we're going to look at more of a global view and some of the pressures that we continue to talk about in Asia and Europe. But we just want to look at what is happening in the U.S. And we always start with this chart just to look at those averages in general. And when we look at the current, right now, the current is at 13.84 million barrels a day of demand. That's looking at what is really kind of driving the show, the gasoline, jet, disti, and resid. And the average right now is at 13.845, which is a little elevated. We think it's going to pare back a bit, and it's going to kind of hang closer to that 13.5, 13.7. But as we keep talking about, when you look at the beginning of March through essentially through April, we normally have an increase in activity. We normally have spring break. You have the just activity as things get warmer. So depending on when, Easter is early this year, with being, I think it's April 5th. So when you think about when is Easter break, I know my kids have Easter break first week of April. So that's gonna keep us fairly well driven higher. It's just gonna be at that reduced level as we have that lockstep down, just because we have seen some cases start to increase in some specific hotspots, which is gonna keep things a little bit paused as vaccines continue to roll out, which we'll talk about in this segment. So let's just now break this out into its components. So when we look at distillate had a small build of 260,000 barrels a day. And this is coming even though we still have that, we're still 12.6 million barrels over the year over year, but we're back that down 3.3 million over the 5-year average. We're going to continue to start to see these build back up as that heating demand really diminishes. We had that last push, as we talked about last week, that last push of heating oil. Diesel still remains very robust, and we'll talk about why that's going to continue to be strong just in general. But the other side of things is imports. Imports were up again, another 51,000 barrels a day. When we look at the year over year, that's up 261,000. The 5-year, that's up 350,000 barrels a day. So you can just see the amount of product that is coming from Europe into the U.S. because, as we keep saying and keep trying to harp on, there is a lot of product in the world, and it's always going to try to find the highest bidder. So right now, because of the Texas blackout, because of that huge record drop-off in refinery throughput, that made the arb wide open, so that's going to continue to come through. The distillate side will start to slow down on the import level. It'll still remain over the year, the 5-year, start to go down on the week over week, while gasoline sees a marked shift up over the next few weeks as we start to see a lot of this armada start to get unloaded into the U.S. And here you can see on the Pad 1 side, 96,000 barrels a day came into Pad 1, again trying to refill some of that capacity. But when we look at distillate, you can see that we normally have, looking over the last 29 years, we typically have that drawdown as we go through April. And then as we come into shoulder season, where we just don't have the same type of heating demand, we start to see those builds come back up and then build through September and then start to come down as heating demand starts to pick up. So again, you're starting to see kind of the seasonality, because we always have to think about this with a seasonal bent, just given kind of where we sit in the world. So gasoline, just to kind of reiterate what we had said earlier, gasoline and diesel flows to the U.S. surged to about 2 million tons in February. About 1.86 million tons of those shipments are still underway, to give you an idea of where we sit in March, as we're only halfway through March, which means that there's more March cargoes. For March, four tankers have sailed so far with a total of 146,000 tons on board. 21 tankers have been booked so far to load 823,000 tons. More cargoes are emerging so far this month, giving you an idea of just what this is. And again, more of this is bent now. It was bent to the disti side. It's now going to be really kind of weighted to the gasoline side at this point, as we've seen so far with this first report. As we were saying, we thought that we're going to get a drop back to the 5-year average. Here we are. Now, as we go through the next few weeks, we think that we're just going to hold right around the 5-year. It'll be above, just in general, just because road diesel still remains strong. So it won't be setting records, but we're still going to be tracking above that 5-year average, just inside the top of that cloud. And the reason why is because your trucking still remains strong. So we still see some strength in trucking. There's still a lot of residual. Denver obviously had about 34 inches fall. So here, this is going to continue to come down. And it's going to really settle out much higher than I think we were even expecting at about 120, 130. But when we look at rates in general, rates are going to start to trend higher just because diesel is a pass-through. And as diesel prices continue to go up week over week, year over year on that base effect, I know for myself personally on an anecdotal level, that from February into March, we got hit with several diesel surcharges because of the increase in diesel prices, as that is a pass-through from one to the other on a consumer level in general. So the one thing is on the total car loads, that's at 2.1%. But when we look at what are the things moving around, grain still remains robust. We had a new record amount of Chinese buying, which we'll talk about in the econ show. Motor vehicle parts continue to be that lag as we've been talking about, which is pressure. We see additional facilities kind of rolling back production due to logistical issues, which is just going to keep some of this slowing down. Now, even before we get an increase in production, we're going to see it's going to show up here first because obviously you need motor vehicle parts to put together a car. So once you start to see that here, you're going to see that that's when some of those bottlenecks are starting to go away, and we'll start to see some of that residual increase. Petroleum and petroleum products will remain slow. Just when we look at that 2020, the problem is now we're going to get into a very difficult comp just because 2020 this is when things started to get a little hairy. On the intermodal side, that was something that, again, was very slow last year. It obviously is elevated on a year-over-year level as we started to see bottlenecks. But when we average it out, we're still going to be at that, upper single digit when we start looking through 18 and 19, just because we do have more intermodal. There's more stuff coming from the coast that has to get into the market in general. And that's going to keep us fairly well supplied, which we're seeing here. So when we look at just kind of taking that snapshot of Los Angeles, you can see that we continue to see an elevation. The previous week, it still remains fairly flat. The year over year is obviously going to be fairly tough, just given kind of where the issues were on a yearly basis, because that base effect is there. So the week over week is going to be some of that better kind of gauge as to activity. And we continue to see that activity increase in general as those shipments that have been delayed continue to show up on our coast. And we'll start to see that pull through, which is why when in the econ show, we're going to talk about how the Chinese PPI going to those highs is just going to continue to pull U.S. CPI higher as we have that upward pressure on those import prices. And then when we just rounding out disti, here's where we see, currently right now as we project out over the next 6 to 10 days, or essentially through, the next 2 weeks, you can see that we have a very warm spell coming through large parts of that heating demand side, which is why, again, that disti component is going to see that slowdown on the heating oil, just because we're not going to burn through the same level as we said last week when we lost about 10 heating degree days, demand days, in terms of just where we're sitting in the current backdrop of activity. Now, flipping to the gasoline side, gasoline had a build of 470,000 barrels a day. And when you see why that happened, you can just look at the imports. So when we look at imports were up 334,000 barrels. It was mostly driven by Pad 1, which saw an increase of 279,000 barrels a day. And when you look at the year over year, 222,000 for the aggregate, 5-year, 293,000. And just, I can't stress it enough, that's not going away. That number is getting bigger. And that's where we continue to see where, in total, we imported 910,000 barrels. We could get to about over 1 million, just in terms of the amount of stuff coming into the U.S. in general, which again is going to keep us fairly supplied in across the board. Now, just pulling up, just because I think it's important to highlight the yield side of the equation. So when we look at yield, So just when we're considering the fact that we have refiners starting to come back online, we have production of gasoline increasing. Obviously, it's increasing the most in PADD 3. But when we look at the production or the yield in DISTI, we're going to see that continue to shift away from distillate and more into gasoline. But when you make diesel, you inherently make gasoline. So the question is going to be, how do you make the best type of gasoline on the topping side, running it through, more of the toppers and the hydrocrackers, kind of trying to get away from some of the coking capacity and some of those FCCs and some of the coking side, and try to go a bit more for the hydro skimmers and some of those adjustments in general. So that's something that is going to have to watch, because we do have a means of trying to accelerate some of this gasoline builds and this gasoline production. Because if you remember, before the Texas slowdown, before the Texas storm, I mean, we had gone from below the 5-year average to seasonally adjusted all-time highs in a matter of 4 to 5 weeks, because again, we had that drop in demand and we had that increase in production. So this is going to be something to watch, as we already have these imports scheduled. But again, just looking at the demand cycles, because gasoline build in general, year over year, we're still down 8.7 million barrels, and 5-year we're still below, and we're still down 11.6 million barrels. The thing that I just want to point out, when we look over the last 29 years, you typically start to see that decrease in storage through the essentially the beginning of April. Then you have that kind of flat point, and then you see the demand continue to increase for summer driving. So some of the comps week over week on that year over year and 5-year are going to get a bit easier as we start to see some of that drop off in that midpoint, just because we normally do see that drawdown as we come into spring, winter break, spring break, and some of that demand starts to accelerate. And this is also a time that refiners like to get rid of their winter grade as they prepare to make that summer grade. Now, finishing on the blending components, you saw that it was essentially flattish. But when you look at blending side, where the year over year we're only down 5.9 million barrels, and 5-year we're only down 8 million, because if you remember the last few weeks, we've been saying that refiners geared themselves at the beginning of Feb more aggressively towards the summer blend, which requires more blending components, because how you make gasoline changes, which is another reason why gasoline inherently gets more expensive in the summer months. So that pickup point is Memorial Day. So this is why the blending component side doesn't have the same type of pain in it, which just means that it opens up the refiners to be more aggressive on making that base for the gasoline capacity on that 87 RON and to about 87 to 91 RON, and they can really kind of hone in on that, which is why we want to look at yields, imports, as well as builds, and to kind of level it with where is demand right now. Now, as we've been talking about, one of the interesting stats, which we'll pick apart more in the Econ show, is we've now had 53 weeks of jobless claims that have outpaced the worst week, which was in March of 2009 during the financial crisis. So just to put that in perspective, when you see these increases on a week over week level through gasoline and a year ago level, where we continue to see these prices pushing higher, and there is a pain point where you're just going to see less activity. Now, there is a certain amount of reopening. PADD 5 continues to reopen. But when we just look at the average for what the West Coast, the West Coast, and this is, you could see how expensive California is, but the West Coast is averaging $3.43. So just to kind of put that in perspective, that is almost 9 cents above week over week, and 41 cents over a year ago. And again, even though we have Disneyland just said that they're going to open up 15% capacity April 29th for California residents only, there's going to be more activity. That's inherently going to happen, which we expect and we've been talking about. The question is how much of this is going to be impactful, just given the pain that we've seen on the jobs front. Then when we turn to diesel, looking at the expense of goods, we continue to see an increase on a week over week, year over year, where we're now at $3.19 across the U.S., with obviously the West Coast at $3.64, California at $3.95, so almost $4 for diesel. If you want to think about what does that mean for the cost of products and goods? Hello, inflation. And then when we look at just what's happening on that week ago, year ago, you can see just that what we continue to see of providing a little bit of a cap on where that demand can really run into. Because if you know you're going to take a vacation in June, maybe you'll save a little bit of money, not do as much during this break. And again, you're going to see some of this movement in general across the board. But again, if you have the money, why not? But when you look at the blending components in general, you can see just where we are versus the 29-year average. We still remain well at the top, and that's going to continue to trend higher in general. Now, when we look at gasoline demand right now, so as we were saying, we expected to see a pullback. It's a lower high. It's a higher low, which is again a positive, showing that direction. And now we're back to where we were in 2012 and 2013, which were those low points here. So it's important because then you can see that huge drop off in March of last year into April. So this is when we're going to start to separate out, because for some reason, some people think that, after 1 year of not having March increases, that March sees an increase in activity. So we want to take this and clean it up and look at what is activity normally done in 2019, 18, and 17. And you can see that we normally get that kind of that low at the end of Feb, and then we start to see those increases. The question is going to be the rate of change of this current backdrop. So will we see a spike in general? So when you look at 18 and 19, those spikes in demand correlate with when Easter falls. So Easter is earlier this year, so we are going to expect to see a bigger increase sooner due to the recovery of travel. We will see more travel versus last year, obviously, and we're going to start to close that gap. The question is going to be how much can we close that gap versus one, refiners turning back on and imports coming into the U.S. So then when we start looking a little bit deeper at some of the other data points, here we look at LPG. Propane only drew down by 50,000 barrels as we come into, again, that kind of flattening point when we start to see those increases in general as heating demand starts to slow. If you go to a restaurant, there's not going to be as many heaters, especially given how warm it's going to be as we head into the end of March. But when we start looking at some of the U.S. data points, the COVID cases are still trending in the right direction, but we're starting to get a little bit of a hot spots. So again, it's just a matter of remaining cautious as those vaccines continue to roll through, which is obviously the most exciting side of getting back to some sort of normalcy. Then the question will be, what do jobless claims look like as those continue to remain under pressure, as we do have about 20 million people receiving some form of unemployment benefits. So then when we look at how is money being spent, in terms of services, we just want to look at ticket services, cruise travel. So we're still at a fairly low number. It's obviously better than when it was, but it's just going to be a sentiment of when do people get vaccinated? When do we see movements? If you remember last week, we talked about how more people are feeling a little bit better about traveling sooner, specifically by plane. That's going to be a net positive, and we continue to see people avoiding the MTA, so that's going to put more cars on the road, away from that, away from just that commuting side. But we have more and more people still working from home. Corporations still aren't opening up before at least the summer, so that's going to again weigh on some of that demand cycles. But you can see that net recovery in general. But just when we start looking at gas stations, that remains strong. We want to see how the gas stations continue to perform as prices go up and see some of that softness that might come in. And then just in general, you can see that even though things have recovered, it's good to put it into perspective as to where were we versus pre-COVID, where were we, and as of currently right now. So then when we shift a bit further, we just want to look at the engagement side of just where we sit in general. And so this chart that we see here, we're now closer in closing that gap to just where we are On the weekend side, weekends are trending much closer to zero. We think it's just above zero. It hasn't updated yet. So once it updates, we'll have the updated data for next week. But the weekday still remains below 20%. And this is where we see that bifurcation of weekend versus weekday that we keep talking about. But looking at Gas Buddy data continues to drive higher. Here you can see just kind of where we sit. U.S. gasoline demand is coming back to that normalcy on the year over year. But again, as we keep talking about, we have to start looking at 2019 to get an idea of kind of where things sit in general. Remember, 2019 we also saw some softness. So because the economy was starting to struggle a little bit in general. So that's why we can look at that as a fairly decent comp. But with that being said, U.S. gasoline demand week over week was just 0.98% below the same week last year, and it's just a matter of when COVID was. But week over week, we saw that another 2.9% increase. We just think that it's going to start to flatten out at this level. And then when we look at Descartes, they're continuing to show that we're at about that 8.9 as we go into the next week. Now, as we were talking about here, you can see that activity at the grocery store, retail remains fairly flat. Workplace, same thing, again, coming to the weekday side. But parks are getting better. So if you are driving to a park, walking to a park, but again, driving to a park, you're going to see that increase. And that's where we're going to see some of those spikes, because you're going to see a lot of that demand come through the market, especially as we look at that weekend data point. But on the mobility side, you can see that the U.S. has had a pretty steady trend, kind of flattening out here. The bigger issue is that drop down in Italy. UK still is starting to see a little bit of an increase as we're getting some of the vaccine data coming through. But Germany and Italy still remain the problem and the headwind in general, as AstraZeneca is paused. In the U.S., AstraZeneca data is now under further review, though we already have 3 of them available. We have the Pfizer, Moderna, and J&J now. So that acceleration will continue in the U.S. But when we just look at the COVID situation, so here when we look at worldwide, we're starting to get an increase. The U.S. is kind of stable at these levels with a small amount of increase. But then when we look at Europe, Europe is where we're starting to see kind of that slowdown, and especially in Asia Pacific. So Asia and Europe are starting to go the wrong direction, and they're much slower on the vaccine pace, which again is leading to that crude oil demand side. India, as we've been saying, has seen a marked increase in some states and provinces. So we have gotten an increase in lockdown stringency, but it's not national. It's more of a localized situation, but that's going to be one to watch as the data gets a bit worse for COVID. South Korea, Japan continue to see kind of this steady state, and they're trying to get some of these declines. The bigger issue right now is when we look at Germany, France, and Italy, where we're starting to get a reversal of declines. And so not only are we getting a reversal of case counts, and case counts are going higher, but we also now have a delay of vaccine capacity. And that's going to just put more of that refined product into the market, which is, just based on the arbitrage still, it's going to make sense to send it into the U.S. as we continue to go through our demand cycle through the second week of April. This is showing where we sit on the administered side. So the U.S. has now fully recovered from any slowdown from Texas, and it's accelerating. I know that they have now moved down some of the levels of a vaccine. I think it was Ohio that is now at 40 or older. It's now more available in the PAD 5, California in general. So we're starting to see some of these vaccines roll out. If you want it, you can essentially get it at this point, which is, again, a net positive for getting some things back to normal. And then that's when we start to turn towards the economic side and some of the pressures that we remain to see on the wage, jobless front in terms of where does that go. But we do have stimmy coming. Hey, yay. So, some of those impacts we'll talk about in the econ show. Now, on the jet side, as we were saying, we were going to get a bounce in jet demand. It's just very muted still. This is going to continue to ratchet up as the airlines continue to prepare for additional capacity when you look at what is happening for spring break, Easter break. So that's going to be helpful. On the storage side, it's fairly flattish. There's really not much where we're down about 2 million barrels year over year, down 3 million 5-year, down 530,000 for the week over week. Again, the demand still remains well below seasonal norms. And we typically kind of, if you look from Feb into March, we normally kind of get that rally as you get airliners starting to get ready, pulling that through, and then we start to see that drop off. And it's important now, so this data has changed a bit. So before it was week over week, but now that we've had that huge drop off, now we have to look at the year a little bit further out. So the data is going to look a little different. So that's why the numbers look as big as they do. But this is now normalized kind of going forward when we look at some 730 more departures on average each day, week on week. Departures were down 27% year on year based on the Bloomberg NEF data. So, but, there's going to be some components to that. The April flight schedule is roughly 8% lower than this time last week. So we've actually had a decline in flight departures, which just listen to the backdrop. China increased schedule flights as Europe and US-based airlines cut again. So you have Europe and US cutting airlines, even though we have more passengers coming through. And the reason why is what we keep talking about is load factors. So as US-based airlines continue to cut flight numbers and passenger numbers increase, load factors at US airlines like American Airlines and United are likely increasing. So given the plane's heavier, so you're going to burn more fuel, but you're burning more fuel in less flights. So again, even though you're getting more people through the gate, you're not seeing the same type of pull through because you're just increasing the capacity in that plane and you're not adding new planes. Again, so you're going to burn more fuel in that full flight, but you're not going to have those extra flights. So again, that's still going to cap where we see that jet demand over the next few weeks. Now, when we look at TSA passengers, this is when we start to separate 19 versus 2020. So here you can see we normally get that increase that usually peaks as we get to the beginning of March, and then we have that kind of that level remain fairly strong just as we go through the spring kind of awakening, if you will. And we're following something pretty similar. So that's really going to take up our load factors that we're going to expect in terms of where we sit of closer to about 900 to about 1.2, 1.3 as we do have more capacity coming on along those seasonal norms. We're going to want to continue to see this drive higher and close this gap between 2019 and 2021. But we're still a few weeks out from seeing that. And it's just given, the timing as people go back to school, then you're going to start to see that drop off. So I don't really think we're going to get back to that just yet. But this is going to be the one to watch to see how that's developing. Then when we look at open table, we've been pretty consistent in terms of where we sit. This is where we think we're going to kind of bounce around at this point. Even though we're having a bit more of a load factor increase in some restaurants, this is looking at global, so the U.S. is getting better, but some places are getting worse, specifically Latin America and Europe still remaining under pressure. And that's when we start looking at the global side. As we've been saying, we think that on a weekend level, we're going to be at that 25% to 35%. And then when we look at weekday, we're going to sit at that pretty much that 45 to down 50%. Really, Germany, Ireland, UK still remain under pressure, obviously because they're still locked down. UK will start to open up, which will keep Germany and Ireland, again, that cap. But then we'll start to see Canada get a little bit better as it gets warmer. US is still trending in the right direction, which will put that upward momentum, which will just increase the capacity, which is another little net positive for some of that demand factors. So that's really everything on the deep dive on refined products. If you have any questions against seasonality, against some of the flows, what does it mean when we talk about yield versus imports? Because there's a lot of moving parts when you just try to start tackling how all of this moves about, because again, some of this stuff is sitting on boats waiting to offload anywhere and everywhere. So again, these are things that we're going to talk about and always look at in general. So in the next segment now, we're going to tackle the export side and where do we see U.S. exports, but also that global construct of demand and storage abroad.